It's the Merlyn.AI Bull-Rider Bear-Fighter ETF. And I can best explain it by just going over its name. It uses AI to try to ride bull markets and fight bear markets, right? So it's either going to be sort of, it's momentum strategy. It's going to use other ETFs, different sectors, countries to try to ride momentum, both sides, whether it's bullish or bearish. It's a new fund, but 50 million still is pretty good for the age that it is. 60 basis points about average for this kind of active strategy. Let's look at the holdings. So again, it's going to hold other ETFs. And what you're going to see here is a very growthy, so right now it's riding the bull market, right? It only rebalances monthly, so even though we've had a couple nasty days, this is still in effect, right? Let's look at the performance of this versus, I picked FVC, it's the First Trust Sector Rotation ETF. There's not a perfect benchmark. And the S&P 500, you can see this kind of saved you a little bit here. This is an ETF, because you're diversified, isn't going to quite get you the same pop of the S&P. It might save a little of the downturn. So, Scarlet, I think this is one that's got a really clever name, and performance will really be what draws investors.
It's always performance. All right, still with us is Dave Epstein of Merlyn.AI. Dave, this is a fund that can shift between different modes: conservative, growth, something in between, and you're relying on AI to make the switch. But I notice it's also monthly rebalancing. So what if you've missed some of the run or a lot of the run? Can humans override the AI?
This is the point of Merlyn itself. So the technology really is based on understanding where the market's going over time. So that's the momentum idea. And this always is looking at a number of factors underneath that sets up for whether you're going into a bull or a bear market. But we don't specifically act quickly on anything, because you don't want to get whipsawed, and this happens all the time. When you get some sort of outbreak of something, all of a sudden you get a sharp drop, but the next day it can come right back up again, and that's what we don't want to do. So we look at the end of the month when the professional traders are trading, and we get that fundamental understanding, and that's where the signal comes in.
Okay, so no human intervention then?
There's no human intervention in this.
Speaking of non-humans, AI, right? It's a word we've been seeing more and more in the ETF world. You break AI down, and you're from Palo Alto, so I feel like this is going to be next level right now. Genetic algorithms, fuzzy logic, and adaptive tuning. So could you try to simplify that for somebody who doesn't really know what that is?
My rice cooker used fuzzy logic, by the way.
Sure. Yeah, AI is the basis for what we're doing, and yes, I'm in Silicon Valley, the heart of it, and I'm studying AI all the time and seeing all different kinds of things. So AI is really promising, and it really is the future of a lot of different things. But for markets, you have to be very careful about using AI because there are so many different factors and variables that go into it that if you just applied basic learning, which is what AI does, then you're going to be creating a lot of noise. You're going to be based on a lot of noise. That's how it's going to come to decision. Instead, by breaking it into this adaptive tuning, which is looking and adapting to the changes in the marketplace, and the genetic algorithm, which is actually evolving over time. So just like genetics in our bodies, there's mutations, and then the survival of the fittest moves on to the next level. And then those also create offspring, and then those are regenerated, and again, it moves forward. So this is using AI in the way that is actually allowing it to evolve without knowing what actually is going to happen, and comes to a better decision.
Was that next level enough for you?
Yeah, I feel like this is what's discussed in Palo Alto Starbucks.
Well, I mean, we talked about Palo Alto, and of course that's home of tech startups and such. Are you disrupting advisors with this fund?
We think that this is actually helping advisors quite a bit, because what this does is it allows in one self-contained wrapper, an ETF wrapper, this allows the advisor to put some of the money into either WIZ or Snug, and these allow over time for it to trade all underneath the ETF wrapper, and they can spend, it's all automated and changing and such, and then they can spend their time doing more important things like getting more clients, like working on other things. So actually, I think this is a better way of being able to allocate their investment strategies for each individual investor, and makes them more productive.
And just to be clear, WIZ a little more aggressive, or can be bearish too, though, but Snug is more conservative.
Yeah, they both work on the fact, so Snug is a 30-70, 30% in equities and 70%, and WIZ is an 80-20 fund. And I noticed you put up the performance there, and you'll see that that one is very, very much closer to an an 80-20 kind of thing. But both of them, in a bear market, switches to nearly 100% defensive.